Hello, everyone. Thanks for coming. Today's presentation is titled Knowledge is Power, What Every Woman Should Know. So men and women can both listen to this presentation, but we're going to focus on helping women so they understand everything about their finances and their financial life, in case they are in a position where they have to handle it or they want to handle it. I'll introduce myself. I'm Lisa Crosta. I work for Crescent Private Wealth. I'm a certified financial planner and a CPA. And I've been working in the industry for 18 years at this point. I love the education part of my job, so I've enjoyed doing these seminars. I do them in person as well, but I thought I would do one, for YouTube so we could share it with more people. Just a little bit about myself. I started as a CPA many years ago, worked in a big accounting firm, took some time off with my kids, and then came back to the industry. And that's where I got my certified financial planning license and some of the other securities licenses that I use now. I have worked with so many different types of clients. My first job back was working with a bigger firm where there was 50 different advisors I was helping. So I saw a wide range of clients. I had one client who told me that he wanted to bounce the last check. He didn't want to have $1 left when he passed away. And other clients who I couldn't convince to spend any money because they want to save everything for their children. So everyone is different. And I'm used to helping people achieve their personal goals. And there's no one answer for anyone. One of the reasons that I do this presentation and I tend to talk to women is because of this stat up here on the screen. 94% of women believe they will be personally responsible for their finances at one point. However, only about half of us are confident and only about a quarter of us feel empowered to take action. Women generally do a lot of household managing, of budgeting and such, but sometimes don't take on the bigger tasks such as building wealth, managing investments, building a diversified portfolio. So I really want to help women feel more comfortable in this situation. A lot of times with couples, there's a division of duties. Nothing wrong with that. But what happens is sometimes women don't handle some of these other tasks that we're going to talk about today. Let me keep moving on. One of the reasons why I said I'm passionate about this and why I think women should learn more about their money are these reasons up on the screen. I'm not going to read them all, but it's our money. Life is uncertain. We have people we want to take care of, maybe kids we want to take care of, charities. And it's very empowering to understand your finances and take charge of them. What we're going to go over today is the real big picture of financial planning. It's like an umbrella. And what does it cover? All these topics: cash flow, which is what comes in versus what goes out. We'll talk briefly about investments and assets, Social Security, life insurance, long-term care, some critical estate planning documents, and how a financial plan can help you ease your anxiety and help you create a roadmap for success. One of the other things that I didn't mention to say on the other slide is that you may have read this in the news. There's about $30 trillion that are going to transfer to women over the next decade. So we're going to have a lot of wealth and a lot of power. So it'd be helpful if we understood, what to do with that. We'll start with cash flow. This is where I begin a financial plan. So when clients come to me, we start with a financial plan. And what do we start with? We start with understanding everything that comes in. Those are your inflows. It could be wages, rental income. You could be collecting Social Security. You could have some side gig business. That's what comes in versus what goes out. That's usually the harder part for people to give me, just go through your expenses and get a good handle on how much you're paying each month. And the key is the net. And my kind of cheat for this, if you don't want to do all the expense part, at the end of the month, are you positive or you're negative? So for example, if you're positive about $1,000 at the end of the month, your expenses are about $1,000 less than your income. So we can fudge it a little bit. But the point is, at the end of the day, is that net cash flow helping you get to where you want to be? Are you living a lifestyle within your means, or are you going negative and building up credit card debt? Are you positive and are you adding to assets so that you can support goals such as retirement, kids' education, maybe a second home? A financial plan can really help you answer these questions. And I just like to tell this one story of a client that came to me and we did this first part of the plan. And she said to me, "Oh, I'm so relieved." And I said, "What?" She said, "I thought you were going to yell at me." I'm like, that's not my job to yell at you as a financial planner. I said, my job is to help you understand and make sure you're on the path for what you want to achieve. And if you're not, how can I help you get there? So this is not a test to see that you're not overspending. This is not a judgment. It's just helping you figure out what's right for you. And it varies by every individual. After we look at the cash flow, of course, we look at liabilities. So the biggest liability for many people is your mortgage. And I ask people to take a look at this because a lot of people remember that they got a 30-year mortgage, but they forgot that they refinanced maybe over the last 10 years when interest rates were so low. So you may have bought a house 20 years ago, but you may have refinanced 10 years ago, done another 30-year mortgage. So you still have 20 years left. So check how much you have left, see what your balance is, check your interest rates at this point. Not very many people are refinancing because rates are higher. But that's really part of your plan. If you thought you were going to be paid off by retirement, but you refinanced and you extended that mortgage, we have to build that into the plan. Home equity line of credit is a second mortgage on your home, basically. These can be used for bigger expenses like helping kids pay for college, maybe a car, maybe, a big trip or some debt that you had. Keep an eye on these. They tend to build very quickly. The interest rates on these went up dramatically over the last year, and they have just flipped. I actually just saw my own personal line of credit just go down 0.5 point. And if the Fed keeps lowering rates, these will probably drop. So keep an eye on it, on these, see how much you're paying off. Most people are only paying interest for 10 years. And then after that, they become fixed loans. So be aware of when that's going to happen. Be aware if you're going to be able to afford that cost when it gets to there, or should you be chipping that away at more of the principal now. Credit cards, they're kind of a necessary evil these days. Keep an eye on them. Obviously, try not to keep balances. It's very expensive to run up credit card debt. And everybody's pretty much aware that if you don't pay your balance off in full, every charge thereafter gets an interest charge. You lose your grace period. And this is something I want you to teach your kids because it is important that kids learn how to use credit cards. Like I said, I think of them as a necessary evil. I had my kids all get credit cards when they went to college with really low credit limits, like $200. And we really taught them discipline to know how to use them and how to pay them off and to understand they have to pay them off on time and you have to pay off the whole balance and you only have so much of a limit. So I really think they're really good tools to give your kids to start learning about money. I'm not a fan of, burying your head and not learning about it. Okay, so after liabilities, let's talk about assets. And I'm going to start with retirement assets because those tend to be people's bigger assets. Not everyone, but a lot of people. 401ks, all the fours, 401ks, 403bs, 457. Those are not government. Those are employee sponsored plans. The first two. 457 is usually when you work for the state or the government. But the point of these is that the money goes in pre-tax. So if you make $100,000 and you put $10,000 into these plans, these first three, when you get your W-2, it's going to say $90,000 of taxable income because that $10,000 is no longer taxable. It went into a 401k or 403b. It grows tax deferred. You must begin taking money out of these accounts at age, it's moved up to 75 for most of us. But some people, if you're born, I'll give you the years. If you're born between 51 and 59, you're required to begin taking money out of this at age 73. Anyone born later than that, it's 75. And when I say take it out, the point is when you take it out, you have to start paying tax on it. And there's a minimum amount you have to take out every year. So I do find with some clients that leave a lot of money in here and wait, that when they're like 85, they have these very large required minimum distributions that push up their tax bracket higher than they would expect at that age. And they may not need all that money. So there's some great planning to do about how to start these required minimum distributions and how to plan your tax bracket. It's something we do in a financial plan. It's not done on the back of an envelope. It's too tricky, but it's something we work with. Also, IRAs are on this list because IRAs can be pre-tax dollars. It depends if you have a retirement plan at work, and it depends how much money you're making, whether they're pre-tax or after tax. But they do grow tax deferred, just like a 403b and a 457. How much you can put into the IRAs is much less than what you can put into the 403bs and 401ks, but it's still a great way to save tax deferred. Now, Roths, whether they're 401k or our IRA, you don't save any money today. So if you go back to my example with you make $100,000, you put $10,000 in these accounts. At the end of the year, your W-2 still says $100,000. You didn't save anything today, but all future growth comes out tax-free. So when you start taking money out of these Roth accounts, you pay no taxes on them. You got to meet a few rules. You have to have them in there for a few years and such, and you have to be, the right age, but 59 and a half. But generally they grow tax deferred and come out tax-free. Having both of these types of accounts is great because it helps you plan a little bit more your tax bracket in retirement. Generally, retirement accounts. Non-retirement accounts, you'll usually see brokerage accounts where you put your money in, you make investment choices. When you take money out of that, you just pay tax on any of the capital gains in there. And you can take them out at any time. There's no penalty. Bank accounts, a great place to park, short-term money, emergency money. Right now, you can still get pretty good interest rates at certain banks if you pay attention. And home is also an asset. And for many people, that's your largest asset. But that, of course, is also not, it doesn't have any tax penalties in it. It's just an asset that hopefully grows. In this part of the country, it does grow. So how do we allocate inside these investments, right? So the bigger umbrella is it a 403B? Is it an IRA? Is it a 457? But what do you put inside of them? So this is where, again, I go back a little bit to women. We tend to be a little bit conservative, and we can risk running out of money when we do that. Only about half of the women invest in the stock market compared to, almost 2/3 of men. However, a recent study by Fidelity showed that when women do invest, we tend to do slightly better because we don't trade as frequently, and our results tend to be better. But we want to be careful not to be too conservative. And I'll tell you a story that kind of broke my heart. I had this couple that they divorced 15 years ago, and they each got $500,000. They had to split assets. I'm rounding a little bit. They each got $500,000. She put her money in the bank and was earning maybe 2% on average over the 15 years. He put it in the stock market, and he averaged 8% a year. And that's not a crazy rate of return because over the last 20 years, the S&P has averaged 10%. So I'm using 8. His money was worth $1.5 million. Hers was worth $672,000. So when he turned 65, he went to the judge and he said, I want to have a right to retire. I don't want to have to pay alimony anymore. And she balked and said, I don't have enough money. I just have this money and it's not enough. And the judge saw what he did with the money versus what she did with the money. And he said, that's not his problem. He has a right to retire and the alimony is going to end. So I don't want anybody to make that mistake. And I'm not saying you have to get into investments that you're uncomfortable with, but you have to look at what you're trying to achieve. And you may have to be a little more knowledgeable in how you spread your money out so you don't run out of money. Where do you invest your money? The asset classes. So really big picture here. Stocks, equities, same thing. Their ownership in a company. They have the highest growth potential pretty much with everything on this list, but they have more risk, meaning they're more volatile. And then they can be further broken down into large stocks and small stocks and growth stocks and value stocks. I'm not going to get into that all here, but these asset classes get a little more nuanced. Bonds or fixed income, same thing. You can buy bonds directly. You can buy them through mutual funds or ETFs. Same with stocks as well, through mutual funds individually or through ETFs. Bonds are more stable. They don't fluctuate as much, but they pay a fixed income stream. If you hold a bond until maturity, it pays back the value of the bond. So they have less risk, but less growth potential. So a portfolio may have a balance of these. Real estate is a different type of vehicle. It can have a lot of appreciation, but it's not liquid, but it can have a place in a portfolio. There's alternatives out there like crypto and gold. And again, this you have to be comfortable with and understand why you're adding them to your portfolio. And the last piece would be more the real stable money markets, CDs. Maybe you're parking emergency dollars in there or money you need in a year or in 6 months, and you can't take the risk of it dropping in value. So they all hold a place. It just has to be done appropriately. Now, the other really important thing about where your assets are and how they're titled is how they pass to your heirs. So certain assets pass directly and some go through the will. And I'd say of everything I talk about today, this is the thing that people were the most surprised to learn. Retirement accounts, all of them, all the 403Bs, 401Ks, all the 4s, all the IRAs, they pass through a direct beneficiary that's listed on the account. I can't open one of those accounts without a beneficiary being on it. And your firms usually won't either if you have a 401k. Those go to who's on the beneficiary form. I have seen mistakes here. I've heard terrible stories of people having their ex-spouse on the 401k. And they go to the judge after death and there's nothing you can do. That's what the document does. It passes to that person. In a worse situation, I would think even is you have 2 kids, adult kids, you put them on there and you had a 3rd kid and you did this form years and years ago and you never added your 3rd kid. Or maybe you think my will says all my money goes to my 3 kids, so it'll be fine. It does not. These accounts bypass the will and they go directly to the designated beneficiaries. So be aware, check them, and make sure they're correct. Joint accounts pass directly to the other holder. So often you see these with husband and spouses. It does not go through the will. It goes directly over. Sometimes you see this with an older adult and like an older parent and an adult child. Maybe they're getting older and they want to make sure when they pass, the money directly goes to the other child. But again, be aware. If you have 3 children and it goes to one, there's no correction here. It's going to go to that person. So make sure you have it set up the way you want to. TOD is something you can put on a brokerage account, and it's just what it says. It's transfer on death directly to who's named in there. Again, I see that more with older parents with adult children, and you can put 3 people, TOD. So the whole account goes to the 3 kids upon death. It does not go through probate, does not pass through the will. Accounts that are outside of this are individual accounts that don't have TOD on them. A lot of bank accounts don't have any TOD on them. Personal property, your home, your auto, that will all go through the will. Just a little note here, you hear probate a lot and you're like, oh, I want to avoid probate. In New Jersey, probate is known to not be difficult, nor is it expensive. Florida and New York are the exact opposite. So depending on where you live, it may or may not be important to avoid probate. The other thing about avoiding probate is it keeps your will, everything that you give away, private. Anything goes through probate is public information. So that's another reason why some people choose to try to avoid probate, because they don't want their inheritances to be public. But just understand that in New Jersey, where I am, probate is not terribly expensive, nor is it terribly cumbersome. Social Security, let's talk about this. This could be a whole presentation in and of itself. I had somebody tell me once that there's only, like 6 or 7 Social Security rules, but there's 27 exceptions to those rules. So it can get complex. But we'll start with big picture. First, everyone should go to ssa.gov and get their statement. It's a really good statement. It shows you what your benefits are going to be at your full retirement age or any other age kind of before or after. Be careful with logging on. You have to answer some knowledge-based questions. If you get them wrong, you get locked out. So I always say to people, if you get a couple wrong, leave and come back and get new questions, because it's kind of hard to get in when you get locked out. Social Security. So once you've worked 10 years, you're eligible to collect Social Security. The earliest you can collect is age 62. Widows can collect at as early as 60, but it will be a reduced benefit, up to about a 30% reduction in benefit when you collect at 62. And I say about because it depends what your full retirement age. Full retirement age is age 67 for anyone born in 1960, anyone born after 1960. Spouses are eligible for either their own benefit or 50% of their spouses. And I'm going to clarify, 50% of their spouse's full retirement age amount. So if your benefit was 1,000 and a spouse's was 3,000, you'd get your 1,000 plus another 500. So that equaled 50% of the spouse. A surviving spouse collects the greater of their own or the deceased spouse. So you may step up into a higher benefit when a spouse dies if they had more. And there's some planning. There's a lot of planning to do here. We look at couples together, and we sometimes have if there's an older spouse who tends to be the male, men tend to die first statistically. And unless there's some other family history that's different, we may say, let's have the older spouse delay their retirement benefits. And I'll explain that till age 70 so they can maximize their benefit. This way, when they pass away, which statistically is going to happen first, the other spouse with a low benefit will step up to that high benefit. So let me just explain that. From your full retirement age, whatever it is, to 70, your benefits increase 8% a year. This is automatic. This is written in the rules. This is not cost of living adjustment. This is separate from that. So sometimes, not sometimes, always in plans, we play around. Like, what makes sense? Should we wait? Should we not wait? We look at where they're going to get other money from in the meantime. What's the health? What's their longevity risk in their family? So these are individual decisions. It's not just everybody does the same thing, but they're complex, and it's really good to plan with this, because pretty much once you make the decision, it's final with a few little exceptions. Quick exceptions. And the last thing is divorced spouses. If you've been married for 10 years, you can collect on your divorced spouse. It does not affect that spouse's benefits at all. They don't even know about it. But those are a little more complex. I'm not going to go into them today. But if you were married for 10 years, keep in mind that you can collect as long as you did not remarry before you turned age 60. So I could keep going on with the exceptions, but I'm going to stop there. Let's turn to life insurance. So life insurance, what do I want you to do here? I want you to look at your policies. Who's the insured? How long is the insurance going to last for? And that goes down into what type of insurance policy is it. Basically, your life insurance is term or some form of permanent. If it's term, it's good for a certain number of years. Lots of people, when they have their first kid, buy 20 or 30-year term policy, figuring when the kid's 20 or 30 years old, they're not going to have to need insurance anymore if something happens to them. But check your policy out. Make sure you know when it runs out. I have had clients rebuy like a small 10-year policy because they wanted a little more coverage. They still had a mortgage. They wanted to be able to leave their kids some money if something happened. So sometimes I'll see clients buy a 10-year policy after the 20 is maybe run out. But just the point here is know what you have, how much, when it's going to end, and make sure the beneficiary is set up correctly. There's no changing this after death. If it's a permanent policy, so it could be a universal life, a variable life, an index life, a whole life, all different names for policies that are intended to last your lifetime. With these, I would like you to go pull yours out and ask the agent who sold it to you to run what's called an in-force illustration. This illustration will show you how the policy is performing today with today's interest rates, with the cost of insurance, with your current age. And some policies have performed beautifully and they built up cash and you can even stop paying the premium and they look so good. And there's other policies where you haven't been paying enough premium and the cost of insurance has been going up and up because you're getting older and what you've been paying isn't covering it. So you're eating into the cash value of the policy and the policy is going to collapse. I've seen both of these. They're all different. There's thousands of different policies. So get this in force, look at it and make a good decision. If your policy is going to collapse, you may want to get that cash out there rather than just burn through it. But again, individual, you got to see the timing, see how long it's going to last and see if you know what your options are. But knowledge is power again here. So understanding your policy. Long-term care. This is a big topic. This is in the news a lot. People are worried about it. The cost of long-term care is very expensive. You can see some of the stats here. About half the people turning age 65 will need some sort of long-term care in their lifetime. About a quarter of those turning 65 will need long-term care for more than 2 years, and about 20% of it for more than 5 years. Women use care more than men do because we live longer. The other thing I was going to point out is that the long-term care insurance can be more expensive for women because we use it more. So how do you handle this potentially very large costs? And for example, I will tell you in New Jersey right now, the cost of a semi-private room in a nursing home is $140,000 a year. It's a daunting number. And let me point out that Medicare does not cover long-term care. All that Medicare covers is 20 days in a facility as long as it has immediately followed a hospital stay. Then from days 21 to 30, it covers about $200 a day, much less than the real cost. And after that, you are on your own. So you can't use Medicare as a way to cover long-term care costs. Medicaid, you have to qualify for. You have to have less than about $2,000 of assets, really low income. So you pretty much have to spend down everything before you qualify for Medicaid. There's also Medicaid planning out there where people give their money away ahead of time, at least 5 years, and you can do some planning with attorneys on that. But it's a little more complex. So when we have long-term care-ish questions, what do we do? So we play around with these in the plan. We often put in a long-term care expense. We'll assume you need long-term care in your 80s, which is the average age you need it. What if you need 3 years and 2 years and 5 years? And we'll put these costs into the plan and say, can you self-insure? Can you cover the cost of these assets? And then we can also put in insurance. This is what insurance costs to cover this much coverage. What does that look like? And we can compare them side by side. Long-term care insurance is kind of in 3 different buckets right now, the kind you can buy. There's traditional, which is sort of like your auto insurance, right? You pay the premiums every year. The costs generally go up every year, and they don't call you at the end of the year and say, here, take the money back. You didn't need it. So that's kind of traditional. It costs less to buy that, but the costs go up over time. The second type of policies are where you have a life insurance policy and you put a rider on top of it, a long-term care rider on it, so that you can access the death benefit for long-term care expenses if you need it. Those are generally pretty expensive because you have to put these long-term riders on permanent policies, which are more expensive policies. But it's a way to get life insurance and long-term care. So you may have a $500,000 life insurance benefit, but you can access that $500,000 during life if you qualify for long-term care expenses. A third way is these hybrid policies where it's not really tied, it's in an insurance chassis, if you will, a life insurance chassis, but the life insurance is secondary. So you can put in the ones that we see the most, they're putting in maybe $10,000 a year for 10 years. So it's $100,000. And they have a long-term care benefit bucket of hundreds of thousands of dollars. Now it varies based on your age, of course, when you buy this and how long it grows for. But you may have a $400,000, $500,000, $600,000 long-term care bucket that you can access if you need it. If you die without using it, that $100,000 you put in goes back to your heirs. So there's no use it or lose it. And all the money goes towards a long-term care expense. So those are sort of the three really general ways you can buy long-term care insurance. So this is a long-term conversation and something that we really study in a plan with clients when we do it. Because it's not only can you self-insure, it's do you want to self-insure? Are you trying to protect your assets from your kids? And I'll tell another little story of clients where the husband had bought a long-term care policy for the wife, and he may have had one too, but he passed away. And the wife was older and she needed care and she kept firing the aides. And the kids were like, come on, mom, you need it. They were uncomfortable. She kept firing the aides and she's like, I don't want to spend any of your money. I want to make sure it all goes to you. And then they explained to her that dad bought a life insurance policy and they weren't paying for it. The life insurance company was paying for it. So she was like, great. She didn't mind anymore. So sometimes there's this peace of mind about preserving your assets and transferring the risk to an insurance company that appeals to someone. So they decide to buy a long-term care policy. So there's a lot of different nuances to look at to make the right decision for you. Estate planning. So this is our last topic of financial planning we're going to talk about today. What should everybody have? The first three items: a will, just directing where things go that you don't have beneficiaries on: your house, your car, maybe jewelry. A power of attorney. We want it to be durable so that if you become incapacitated, the power of attorney still holds up. So somebody can pay bills for you if you're in the hospital. Somebody can deposit checks or stuff like that if you're in the hospital. A healthcare proxy is a similar thing, but for healthcare decisions. It gives somebody the authority to make decisions for you if you cannot. And it's very important that healthcare proxies today have the HIPAA language in there, which I'm sure you've all seen at your doctor's offices, that say not only can they make the decisions, but they can see your medical records, because it's hard to make decisions without seeing medical records. So we do recommend that you appoint somebody for each of these two things: power of attorney and a healthcare proxy. And my tip on healthcare proxy is also get them for your college age kids and your older parents, not just spouses. So when my kids went to college, I made sure we had these completed, because if this, God forbid, something happens to them and they're many states away and they end up in the hospital doesn't have to talk to me. They're all over 18. With the healthcare proxy, you can send that over, and now you have the authority to speak for them and get all the information you need. It's very important. These are not expensive documents to have lawyers draw up. And also for your older parents, if one parent has passed and there's only one parent left, make sure the adult kids have the authority so they can help if they need to. A living will is more optional. It sets out really specific criteria for what you do and do not want if something was to happen to you. Like, I do not want a feeding tube. That's probably the most common one we see. So that trumps the other things. That's the decisions that your family should follow if you were incapacitated, and the doctors. Trusts. Now, these are optional too. There's many, many types of trusts. There is a lot of revocable trusts that may get the assets out of your estate. There's Medicaid trusts for that type of planning. And there's revocable trusts that don't do anything from an estate tax standpoint. They just set things up really neatly to pass when you're no longer here. That is the simplest explanation I could give just to touch upon trusts. The other thing I want to talk about here really briefly is the federal estate tax laws. People get really confused about these. Right now, a couple can give away $26 million roughly without paying any federal estate taxes. That's a lot of money. Last year, only 4,000 taxable estate tax returns were filed in 2023. This law is going to sunset in 2025 if Congress does not act, which means it's going to go away. At that point, it will go back to the old exemption numbers, which instead of 26 million for a couple or 13 million each, it's going to be about half. We don't have the exact number because of inflation. Let's say roughly $6 to $7 million each person can give away beginning in 2026 if the law sunsets as expected. So again, you won't pay a federal estate tax until you have an estate worth more than that. So not everybody needs to rush and get these trusts done to move money out of their estate because those are pretty high thresholds. And since I'm in New Jersey, I'm going to touch on New Jersey. New Jersey is one of just a few states that has an inheritance tax, not an estate, but an inheritance. If you give money away to a non-linear heir, so not a kid, not a grandkid, and not a spouse, there is a tax associated with that the recipient pays. So siblings, nephews, cousins in New Jersey pay an inheritance tax if they inherit something. There's too many states to go into, and I don't know where you're watching this from, but that's where I am. So that's what I'm just going to touch on. So how can a financial plan help? I mean, I touched on a lot of things throughout the presentation of where we use a financial plan, but it really helps you understand what you owe, what you own, what you spend, and what you save. What do you look like now? And what's the roadmap for the future? You know, if you get in the car and you put in the GPS where you want to go, it can't tell you how to get there until you tell them where you want to go. So this is where a financial plan, you can say, what are my goals? My goals are retire at age 70, to buy a second home, to give each kid money, to give money to this charity, to bounce my last check, whatever it is you want. That's these end goals. And there's usually multiple of them. Our plan can help you find a roadmap to achieve these. And I do really find that when people do a plan, it eases their stress. I had someone tell me the other day that she's looking for her financial peace, which I thought was really cute. Questions a plan can answer. I mean, this is endless, but you can see some of them on the screen now. One of the most common is, when can you retire? You know, are your assets going to last throughout your lifetime? And I'll tell one last story of a client of mine who loves her job, but in the plan we have her retiring at 67, I think. And we went over her stuff, and she said, can you see what it looks like if I retire earlier? So there's this little section there, and I just slid it over to 65 and it looked great. She's like, slide it over some more. So we moved it over to 62, and then she's like, just a little bit more. So over to 60. At that point, her husband's like elbowing her, like, what are you doing? But at 60, her little chart still looked great. She saved a lot. She makes a lot of money, and 60 still worked for her. So I don't know what she's going to do, but it was really fun for her to be able to play around with the plan and see what it looks like. So those are other things on the screen there that a financial plan can help you with. And this is really what I've seen in person. You know, people are confused. They're overwhelmed with financial jargon, overwhelmed with multiple goals, not sure if they can get there. Just the whole thing. When they get a plan, they have clarity and they have confidence. And I really see it ease clients' stress. I actually had 2 clients once quit their jobs after doing financial plan. They were older women who had worked a lot, saved a lot, and didn't love their jobs. So they quit. And I have to say, they were some of the happiest clients I had after that. Not that everyone wants to quit, but those 2 women did. So that's where I'm going to end it today. I'll just with some information. This is the firm, Crescent Harbor. There's my contact information and where you can reach me at Crescent Harbor. I'm happy to do a 30-minute appointment with anybody who wants to reach out by email. And I hope you enjoyed today. Thank you so much for sticking with it. Good night.